The March jobs report has good news and bad news. Employers slowed their pace of hiring dramatically to the tune of just 98,000 jobs. But meanwhile, the nation's unemployment rate ticked lower to 4.5%, the lowest in 10 years. Joining us now to break down the numbers is Stephen Russolillo, WSJ's ahead of the tape columnist. Hi, Steve. Let's start with those 98,000 payrolls. Economists were expecting a lot more than that.
Yeah, more than double that.
So how did they get that so wrong?
Yeah, you know, it's surprising. We've seen several months here of really good, strong job growth, and this month is clearly a blip in that trend. I would argue it's not that big of a deal. You tend to see these monthly numbers can be a little bit volatile when you look at just one number.
And weather had a lot to do with it,
Weather
right?
had a lot to do with this, too. A lot of people were saying that, you know, March, you had that big winter storm Stella that was in the middle of the month. That was right during the Labor Department's survey week. Basically, that's when they ask people about their employment conditions, and so that played a big role.
Especially with construction jobs.
With
probably,
construction jobs,
right?
yeah. So you saw a huge spike in construction jobs in January and February of this year, and so now this is a little bit of a pullback from that. And so construction was hit. Other weather-related industries were also hit in this
Retail also
report.
didn't do very well.
Retail's not doing well at all. You've seen, if you combine February and March, it's the worst 2-month stretch for retail hiring since the financial crisis, since 2009.
Right.
So, yeah, there's some things here, some pockets here that are certainly not doing as well.
But let's look at the good side. People are confident enough to go look for jobs. Unemployment rate is low. Wages are ticking higher.
Exactly. Unemployment rate is at its lowest level in 10 years, as you mentioned. Wages are looking good as well. You saw average hourly earnings up 2.7% from a year ago. You know, basically throughout most of this recovery, you've seen that number right around 2%, pretty stagnant. Really, in the past 6 months or so, it's finally started to tick higher. So people are making more money. That's giving them more incentive to quit with their jobs and maybe look around and try to find.
Employers have to compete a little harder for those qualified workers.
Yeah. And when you look overall at the 98,000 number, the headline number, yes, that's worse than expected. But if you look at a 3-month average or a 6-month average, the economy is doing really strong, at least here on this labor front, and good enough for the Fed to keep raising rates.
That was my next question, because we know that they have indicated they're going to keep raising. There's nothing here that would make you suspect that they would stop that plan.
Right. I would agree with that. I think the unemployment rate is going down for all the right reasons here. 4.5% is where the Fed expected the unemployment rate to be by the end of the year. It's only March, this report, so arguably it has more room to go even lower, which could give the Fed more incentive to raise perhaps even faster. I want to say that very cautiously because we've never seen the Fed do anything really fast in this recovery.
But in general, the economy looks on track.
On track, yes,
all right.
absolutely.
Stephen Russolillo, thank you so much for all that.